Are you waiting for mortgage rates to come down in Canada? You may be waiting for a very long time. Canada's biggest banks just released their 2026 and 2027 forecast, and here is what most homeowners and buyers need to know what they can expect at Bank of Canada's announcement. So today, in few hours in July, Bank of Canada governor will be announcing monetary policy and which direction they are taking the rates. And the next announcement would be September the 2nd. Right now, Bank of Canada's overnight rate is sitting at 2.25%. Almost every major bank agrees with one thing. Rates, they are expected to stay on hold for the rest of 2026. Where they agree is 2027. There are two camps. First is the hold camp, second is the rise camp. In the hold camp is TD Bank, Bank of Montreal, CIBC. They believe the rates could remain around today's level till the end of 2026. The rise camp is RBC, Scotiabank, National Bank. They believe stronger economy growth and inflation could push the rates gradually higher. RBC, which is the biggest bank in Canada, is the most aggressive forecasting rate, and they believe the rates by the end of 2027 could reach as high as 3.25% overnight in Canada. So the biggest takeaway, no major bank expects return to the ultra low mortgages and those rates enjoyed by Canadians pre-2022. What that means is, here is where Canadians get confused. Variable rate mortgages follow Bank of Canada's decision, which will be happening in few hours today in July. Since most economists expect the rates to stay unchanged in 2026, don't expect major payment reduction if you are on variable mortgages. Fixed mortgages, they are different. They are influenced by Government of Canada bond yields, not direct announcement by Bank of Canada. Most economists and mortgage brokers, they expect 5-year fixed mortgage rates to remain relatively stable throughout 2026, generally in a range bound mid 3% to low 4% range, depending on the lender pricing, bond markets, whether the mortgage is insured or not insured. So whether you are buying or renewing, expect stability, not dramatic rate drops in 2026. What could change everything? So these forecasts by the banks could change if we see a couple of factors. Number one, inflation rising again. Oil prices staying higher for long. Trade tensions with US persist, stronger than expected economic growth, or in case of a recession, which could actually lead to future rate cuts. Nobody knows exactly which path Canada will take. So here is the strategies for the home buyers and homeowners. My advice after 20 years in real estate is, number one, don't try to perfectly time mortgage rates. Second, get pre-approved and understand your budget. Third, compare both fixed mortgage and variable mortgages with your mortgage professional. See the spread. What is the difference if you get 3 or 5 years variable versus 3 or 5 year fixed? If you have stomach for volatility and you want lower monthly payments, variable might be an option, but if you want to sleep good at night, the spread is less in your case, fixed might be a better option for you. Also remember the penalties. If you sign 5-year fixed and your life situation changes in 2 years To break the mortgage, you might end up paying way bigger of a penalty to have any meaningful savings in your interest rate early on. So if you're renewing, shop around, start the process 3 to 6 months early instead of automatically accepting your lender's first offer. Remember, the biggest financial mistake isn't buying at the wrong rate, it's delaying a good decision while waiting for the perfect market that may never arrive. Follow me for more Canadian real estate updates, Greater Toronto area real estate prices, how they are doing on my channel, mortgage insights and practical strategies to help you buy, sell and invest with confidence. Thanks for watching. My name is Jimmy Singh, broker owner with Fortune Realty. Talk to you soon.